Welcome back to Palisade Radio. I'm your host, Tom Bodrovics. Joining me again on the program today is Kevin Wadsworth, better known as North Star on Twitter. He's one of our go-to technical analysts. How are you today, Kevin?
I'm good today, Tom. How are you?
I'm great. I think we could start today is you have a pinned tweet at the top of your Twitter page that's kind of the acknowledgement of a low probability outcome. And I think it frames our discussion today really well, because when we see this volatility in the markets and we see charts that don't necessarily behave as we expect them to, this is a good thing to try and remember, right?
Yeah, it is. Yeah, I mean, my background in weather forecasting has taught me that low probability events do occasionally happen. It's, I suppose, a statement of the obvious that not everything that happens is, has a 100% probability. So that's just life, basically. So when it comes to forecasting the markets, you really need to sort of look at all the supporting evidence and gather as much evidence as you possibly can, just like I do when I'm formulating a weather forecast. And the evidence will point in one direction or another. Sometimes the atmosphere is pretty chaotic and the evidence can point in several different directions, and it leaves you scratching your head and wondering what the weather's going to be doing in the next couple of days. And the same thing's true of financial markets. The evidence is sometimes very clear and is all pointing in the same direction, and sometimes the evidence is very mixed, and that kind of leaves question marks. So the best that we can do is gather all the evidence, whether it's evidence from cycle analysis, whether it's evidence from Fibonacci levels, whether it's support and resistance breakouts, chart patterns, technical indicators, fundamentals. You just gather all of that evidence. It'd be crazy to sort of disregard anything, really. Every bit of evidence you can get hold of, it's just like a piece in a jigsaw puzzle, and you put it all together and you come to hopefully some sort of educated conclusion. And just, one example of that is, we were talking about this earlier on, is the chart for Bitcoin at the moment. The cryptocurrencies at the moment are experiencing a pullback, just as, precious metals are. And the chart patterns sometimes do get broken to the downside. So there's a very clear arc formation for Bitcoin, which I've been posting on Twitter. And that arc pattern has been in place since 2017. And it's supported the price both on the way down and on the way up very well indeed, as well as a sort of a pennant pattern, which is superimposed within that arc. So, I mean, all these patterns, you hear people turn around saying, well, they're just squiggly lines on a chart. Well, they're a bit more than that, because price tests the support and resistance levels. The reason that they are support and resistance levels is because price reacts when it touches that line. It's like a red hot kind of line in the sand, and price will touch it and fly off in the opposite direction, and that's what puts that sort of support and resistance line there in the first place. And eventually, the price will test that line with enough strength and enough power and enough momentum, and it'll break through. And that's recently happened with Bitcoin. It broke through the upper resistance line of the pennant, somewhere around about just below the $10,000 level, or around about the $10,000 level. And at the same time, it was bouncing off the support line of the arc. So, that confirmed both of those sort of trading patterns. It validated them. So what's happened recently is we've formed a bullish pennant just on the edge of the arc, which was, on the face of it, very, very bullish indeed, and pointed to prices going upwards. But going back to what I was saying about low probability events, you can't ever discount price action. And you have to remember that in financial markets, just the same as in weather forecasting, it's sometimes very easy to get carried away with your technical analysis and your computer models and, what everything on your screen is telling you should happen. And then, what is actually happening in the real world outside of your window. No good pushing out a weather forecast saying it's going to be dry and sunny today, and you look out the window and it's pouring down with rain, and then you're talking to a customer and they say, well, so what's the weather going to be like, Kevin? And it's you're sort of saying, well, it's going to be dry and sunny today. Well, no, it's not, because it's actually raining outside. So you have to take reality into account, and reality trumps all of your theories and all of your models and all of your everything you might happen to think. Reality wins every time. So that leaves us with where we are with Bitcoin at the moment. Price has dropped out of the arc, as it did in March. And if you look back at March, we've got some wicks on the candles that extend out of the arc and down to the pennant support line. And we could very well be seeing something similar happen here, with price dropping down out of the arc and down to this pennant support line. Now, where that support line is depends on exactly where you put the upper line for the pennant pattern. It could be that we've just touched that support line at around about sort of the $10,000 mark. give or take. And that is quite a high probability likelihood because that $10,000 level is psychologically very important. But that would be if you place the line on the monthly wicks of the candles. If you actually pull the upper support line down to sit more solidly and more squarely on the monthly candles, then you could foresee a situation where price spikes down to just below $9,000 and then rapidly reverses. So I do expect a rapid reversal, and I'd be extremely surprised if we close the month outside of this arc formation. So I remain bullish on Bitcoin. I remain bullish on precious metals and commodities in general. So I'm seeing this sort of pullback as a buying opportunity, and my whole sort of approach to the sector over the coming few years is buy, hold and add on weakness. So we're experiencing a weak period at the moment. So if you're wanting to get into these markets, then this is an ideal time to do that.
Sounds like a great plan, Kevin. And as you say, that really highlights that low probability outcome as a perfect example for, we can make all the educated guesses and build that jigsaw puzzle as we want and still see something out of the ordinary. So let's move on to the price of gold. And one thing you really have highlighted here, again, is, of course, the cross of the MACD. So why don't we start by defining again for our listeners the MACD and what that signifies?
Yeah, so MACD stands for moving average convergence and divergence, and it's tracking the trend. It's a trend sort of momentum indicator. And those two lines are just showing the relationship between moving averages. Without getting too technical about it, all you sort of really need to sort of take away and understand from it is the signal that is associated with those lines. So there's a blue line and an orange line when you plot them on TradingView, and whichever time frame you're looking at, the bullish blue line above the orange line. So that's where you have a situation where prices, the momentum is upwards in terms of the stock price and whatever it is that you're plotting on your chart, whether it's gold, silver or whatever else. So the bullish signal is given when the blue line crosses over the orange line. And the opposite is true, of course, when the blue line drops down below the orange line and the signal at that point it becomes bearish. So looking at the gold chart at the moment, we've had a bearish cross, which, the blue line fell below the orange line on the daily chart, looking at in particular. And so, we've had that sort of signal that prices are likely to experience weakness. And that's when you start looking, basically, the only point of this, it's another piece of evidence, another piece of the jigsaw puzzle. It means that you start looking downwards rather than looking upwards. So you start sort of looking at support levels and what type of chart pattern might be forming and where price might be heading. And again, it goes back to my overall approach. And everybody's going to have a different approach in these markets. Some will be day trading, some will be sort of trading in and out of the markets more frequently than others. In my case, I'm holding a large core position in precious metals and will add to that core position on weakness. And my initial thoughts actually were, a couple of weeks ago, where the price would fall back to somewhere around about the $1,800 level. Now, I sort of theorized that that we would be sort of forming a bullish descending sort of wedge pattern. And I've posted that on Twitter, and we appeared to break out of that wedge formation, and things were starting to turn increasingly sort of bullish, certainly on the shorter time frames. And it did look as though there were some signs that we may have, put the lows behind us. Individual mining stocks were starting to look, promising and quite bullish. And the GDX was holding up quite nicely, for example. And the silver miners were holding up quite nicely. But we've started to see further weakness, and that 1923 level is being tested sort of on multiple occasions. We just sort of dipped briefly below it by a very small amount in the spot gold. So we're at a bit of a decision point here. If the 1900 to 1923 level continues to hold, then the longer that goes on, the greater the probability that we're just going to see a correction in time rather than a correction in price as we go forwards through the next sort of week or two. But, we're at a point here where price could quite easily drop a little bit further. And if it does do that, then it starts to open up the possibility of $1,800. And I think if I was pushed on it at the moment, I think we've got unfinished business with $1,800. So my gut feeling, I suppose, at this point is that we probably will see further weakness, but it is finely balanced, and it's a tough call at the moment. Do we go up from here and see new all-time highs, or do we need to go back further? I think sentiment is still a little bit elevated when you look at some of the metrics. We're a little bit. I'd be happier, put it that way. I'd be happier if we cooled off some more, and if we did dip back down to somewhere between $1,750 and $1,800, then I'd be much more bullish. And I'd be sort of going all in at that point. But where we are at the moment, I'm a little bit undecided. One thing I am certain about, though, is that we're in a long-term bull market. So, I'm not even slightly tempted to trade out of any of my positions at the moment.
Some great information there, Kevin. What kinds of factors go into you really trying to see that support level at the $1,800 level?
Yeah, the sort of 1,800 to 1,850 level is a very important breakout sort of level. I've identified that a couple of years ago, and very significant. The top of the arc that I've been sort of drawing for many years sort of comes in at around about the 1,800 to 1,850 level. I prefer, through bitter experience, to sort of talk about sort of support and resistance zones rather than very thin straight lines. I think when you're looking at sort of daily time frames and weekly time frames, it's more feasible to draw very thin sort of lines that mark a sort of a line in the sand, if you like. But when you're looking at sort of time frames that are measured in months and years, it's much more possible that you get spikes sort of more deeply into that support or resistance zone, and you can have I think Patrick is another one who sort of defines these with volume, and where you get these support and resistance levels, it's generated by trading volume at those levels. It usually sort of covers a span of at least sort of $10 or $20, if not sort of $30 or $40, and you can sort of identify a zone where price has encountered support or resistance in the past, and there's sort of a very strong zone that extends horizontally in that sort of 1,800 to 1,850 sort of zone that goes back many years. So that's why I sort of identify that level. And even quite recently, when you look back at July of this year, as price came out of that 1,800 level, it was sort of held there almost like a magnet, for a period of time before price accelerated away to the upside towards the end of July. So that's my reasoning.
Excellent. And I think obviously moving on to our next chart here, you have three of these zones kind of defined on this silver chart. Just as a reminder to all our listeners, all these charts are on the YouTube video. So this is one of those interviews that are probably better to be seen on YouTube, as well as all the links are always going to be in the show notes as well. So tell us a bit more about the zones that we have identified on this silver chart.
Yeah, so these are sort of three horizontal support levels. So we're sort of bouncing sort of quite happily off one of them at the moment. So we've got three support levels there. One's at, round about where price is at the moment, sort of $26 or thereabouts. And further down below that, we've got another sort of support level down at around about $23.50 or so, and another one below that, somewhere around about $21 or so. And these are sort of defined by recent price action. You can sort of see how the candles and the wicks sort of extend into these zones and then are rejected and pushed back in the opposite direction. So, we, as I say, bouncing at that sort of top support level at the moment. We're sort of come down below the apex of the symmetrical triangle. And I've got some dotted lines on there which are sort of just possible indications of an expanding sort of wedge type pattern megaphone, I suppose you could call it. So the jury's out on this at the moment. Silver price has been going sideways effectively for the best part of 3 weeks. So, the jury's out. We haven't had a decision one way or the other. I expect, really, I think in my heart of hearts, that price probably will drop down towards $21. We've had a very rapid, extended period of price accelerating to the upside. I think much higher targets lie ahead. And I think, silver price is going to accelerate, to certainly $35 or so in the next couple of months. And I think next year we're likely to see $50 to $60 and, before a larger pullback into the eight-year cycle low, and then much higher targets beyond that. I think the pullback at the moment, when sort of viewed in context in a few months' time, will be seen as a sort of necessary consolidation or correction. You need to reset sentiment when things get too bullish. You need to sort of get buyers back into the market. People are not just going to keep buying in on a runaway express train. You need these pullbacks for people to sort of feel that they're getting back into the market at an advantageous point. But we are in a bull market, and surprises tend to be to the upside. And it's worth remembering that, we're sitting here or I am anyway, sort of thinking that price is quite likely to drop back down to around about $21, $22, something like that. But, in a bull market, things catch you out to the upside rather than to the downside. And so we need to be, alert to the possibility that the price will just start to accelerate away again. There are a number of further pieces of evidence that we'll look at in a moment that sort of give us some clues as to where this might be going. But for the time being, it's a case of monitoring the chart for more clues.
Absolutely, Kevin. And I think another point worth mentioning there that you brought up on a couple occasions here is the cyclical high and low. So can you just kind of shed some more light on that for those that haven't heard that before?
Yeah, I mean, in very basic terms, just again, I keep sort of talking about weather forecasting, but it's my background. But, life as a whole goes in cycles, spring, summer, fall, winter. Everywhere you look, there are cycles to what's going on in the natural world. And exactly the same thing happens in financial markets. Investments take place in cycles, whether it's commodity cycles or whether it's general equities or whatever it is, whether it's the energy markets follow a seasonal cycle for obvious reasons. Natural gas will follow a seasonal cycle as demand sort of ebbs and wanes through time. And the same is true with precious metals. And the evidence is there. Looking back on the long-term charts, you can identify large cycles that oscillate on the time scale of years, and there are smaller cycles which are a lot harder to identify, and you need to have a more skilled and trained eye to identify the cycles on shorter time scales of months or even sort of weeks and days. So I can only recommend that people follow people like Norvast on Twitter, who are cycles experts, and he very clearly identified, and so did Grady on Twitter, and no doubt others, that we had this cyclical decline ahead of us. And as a technical sort of analyst and a guy drawing up these charts and support and resistance levels, it gave me a sort of a heads up as to where sort of price might be heading over the next few weeks. So I'd certainly recommend people follow them on Twitter, because whilst it's very complex and complicated, it's very easy to sort of get the general gist of what they're saying, and it gives you a sort of a head start on sort of expectations of where the probabilities lie. And so when you're looking at what the probabilities are for price direction over the next few days and weeks, this is another piece of the jigsaw puzzle. Everyone was very bullish, and myself included, starting to turn bullish and looking upwards with where we might be going with prices for gold and silver. But you have to sort of keep your feet on the ground and stay very much down to earth, and by following the cycle analysis of guys like Grady and Norvast on Twitter, that sort of gives you a real sort of head start in that. So yeah, certainly a cyclical nature to the markets. They ebb and flow up and down, and that's exactly what's happening with gold and silver at the moment, is that they're putting back into a cyclical decline, which was well forecast by these guys.
Perfect, Kevin. Let's move on to the US dollar chart. You're saying that there's a decision point here, and you have a lot of different indications on this chart. So tell us more about what we're seeing here.
Yeah, so this takes me to the doomed or domed dollar chart, which I've been posting online and certainly on Twitter for the last 18 months or more, and online for at least couple of years. And again, this is by virtue of the fact of sort of identifying the cyclical nature to the behavior of the US dollar. So that's what makes me overall bearish on the dollar at the moment. So my bias, and I should say at this point, I'm not a perma bear or a perma bull when it comes to any markets, because I describe myself as a realist, because I appreciate the fact that there's a cyclical nature to all the markets. So there's a time to be bullish and there's a time to be bearish as a sort of overall macro kind of view. And at this point in time, it's my opinion that it's time to be overall long-term bearish on the dollar, because we're in a long-term cyclical decline. Price has been declining for a good while now with the US dollar. And at the moment, we're at a bit of a decision point. We've seen price. I've seen the dollar index dropping from well over 100 to where it is now in the low 90s. It's pushed back up a little bit over recent days, and it's pushing back in towards the mid 90s. But there's a very clear sort of trading pattern there, a descending sort of wedge pattern, which has reached a sort of a decision point. It's reached the upper level of that wedge, and a couple of choices here. We either sort of break out and in the process, break through a sort of a horizontal sort of resistance level that's marked on the chart there with a red dotted line, which probably takes us up to the higher sort of resistance zone that I've marked, anywhere between 95 and 96.5. And I just kind of sort of theorized that, if we're in a sort of bear market with the dollar, which I believe we are, on the dollar index, that will form some kind of bearish trading pattern, bearish rising wedge, something like that, that will bring us back down again. And that, if you stand back and look at it, sort of looks a little bit like an inverse head and shoulders pattern, which would project downwards and take us down further into the 80s. The alternative to that, of course, is that price is rejected at this upper resistance line and maybe bounces around a little bit more within this trading pattern and eventually breaks down to the downside. And that kind of ties in with the sort of possible further drop with the precious metals as well. If the dollar breaks out above this decision point and we get a daily close above that decision point, then that's going to be telling me that my scenario of $1,800 gold and $21, $22 silver is looking like the high probability outcome. So at that point, you're able to say more clearly where the probabilities lie. At the moment, it's very much 50-50 because we're at a decision point. But if that that line is crossed with the dollar and we get a daily close above that resistance line, then the odds suddenly shift and swap over, and the odds will then favour further appreciation of the dollar and a further depreciation of precious metals for the coming probably couple of weeks at least.
Yeah, it's going to be interesting to see how the dollar and the precious metals move in conjunction. Our next chart definitely shows that better than anything, obviously, is the gold to silver ratio. So this kind of looks like a decision point here as well, correct?
Yeah, it is. And you get this, you get this synchronization between the markets all the time, that all the markets are connected, and I suppose it's unsurprising in a way that all of the indicators arrive at a decision point at the same time because they're all connected. If the dollar goes up, then there's I also have to say at this point that just because the dollar rises, it doesn't necessarily mean that gold is going to go down. If you look at the period from 2018 through to earlier on this year, for a couple of years, the dollar was dropping whilst gold was rising. So the point I'm trying to make is that the two aren't necessarily inversely correlated completely, but it clearly gives a headwind for gold if the dollar is rising. So certainly US dollar denominated gold, if the dollar index is rising, then gold is going to struggle a little bit more. If the dollar continues to drop, then gold's rise will accelerate. But gold has risen over the last couple of years, despite the dollar also rising over the last couple of years. But clearly, just recently the dollar's taken a hit, and that's kind of turbocharged the precious metals bull market. And the gold-silver ratio is a further sort of piece of the jigsaw puzzle. During the precious metals bull market, in the early stages, the gold-silver ratio will drop quite markedly, and that's happening because silver is benefiting more rapidly during this sort of phase of the bull market. So silver's rising more rapidly than gold, so the gold to silver ratio drops. And so at the moment, we've been forming a sort of a wedge formation, a sort of triangle formation with a horizontal base. And so we're up against the upper resistance line at the moment. So the gold-silver ratio is at a decision point. It's either going to break upwards out of that sort of trading pattern, which will likely take it up to the 83 level at least, or it breaks down, below that trading pattern. And that would sort of indicate to me that the next stage of the sort of precious metals bull market is going to be underway. So again, if we get a daily close above that line, in conjunction with the dollar having a daily close above its resistance line, then that's another piece of the jigsaw puzzle that would tell me to expect a much higher likelihood of gold and silver dropping. And I should say also that silver will drop, as the percentage drop for silver will be greater. And if you do the maths, a drop from where we are at the moment down to $21 or $22 in silver is a greater percentage drop than it will be for gold if we drop from where we are now with gold down to $1,800. So that all kind of ties in. But at the moment, that's just, a scenario. We haven't had confirmation one way or the other at the moment.
Yeah, and that's fairly typical of the silver market to see more volatility, right?
Yeah, well, it's a more thinly traded market, and a little bit like the uranium miners, where you get thinly traded markets. They're much more volatile purely because it doesn't take as much money to come into the market, as much investment to move the shares, much further in terms of percentage rises or percentage drops. So, they're much more susceptible to very large rises and very large drops as well. But given that we're in a precious metals bull market, then some of the more thinly traded gold and silver junior miners are obviously where you're going to get the big money being made.
Perfect. Let's move on to Hecla mining as you're speaking about the gold and silver miners here. So what are we seeing on this chart, Kevin?
Yeah, the reason I pulled this chart up, they're North American gold and silver and base metals mining company. So they may well be benefiting from they certainly will be benefiting from a range of price movements across a range of the metals markets. Hecla's had some very impressive moves, over recent months, and sort of doubling in price over a period of a few months this year, from a couple of dollars up to sort of $5 or $6. So, more like a tripling in price, in fact. We've got a couple of very clear sort of bullish pennants there. One of them broke out back in late June and reached its target and stopped short of the long-term resistance line. And it started to build out another bullish pennant. And a couple of things to sort of note here. One is that the measured target of the latest bullish pennant takes us above the long-term resistance line, which would be incredibly bullish for this particular stock. But it's also reflected across many other mining stocks, many other junior mining stocks, whether it's in the gold or silver space. There are a lot of them at the moment sort of building out what look like bullish chart patterns and are currently back testing or getting very close to, or actually sort of touching the lower support lines. So I don't know, again, it's another piece of evidence, isn't it? I suspect that these individual miners will sort of back test all of their support lines at the moment, and it's a case of trying to get in at a time of maximum fear. And you're looking at these chart patterns and you're thinking, crack, if they break to the downside, how low does it go? And it's very, very worrying, but it's a good time to invest.
Perfect. And I think that's very helpful as we're trying to look at and add on these moments of weakness, right?
It certainly is, yeah. And the indicators, the technical indicators, are important to look at as well. You can see the MACD there is descending and approaching the zero line. It'd be very bullish if it starts to turn up before making contact with the zero line, or in fact, as soon as it starts to turn up and makes a bullish cross, then that's the time to sort of become really bullish on the stock again. But, this, for the time being, it's a bullish trading pattern. It's a bullish chart pattern. You have to take it at face value. And a lot of them in the sector are looking like this. So that's one thing that makes me sort of wonder if we are actually going to see very much of a further pullback in metals prices, or in fact, if the metals do have a more significant pullback, perhaps some of the miners are going to lead the metals out of that pullback and will turn around as they hit these support levels and not actually pull back much further.
Great. We have energy fuels here on our next chart. So are we seeing kind of the same pullback setup right now on that chart?
Yeah, it's very similar, isn't it? Very similar indeed. And it's interesting, that multiple markets, and certainly in the commodity space, are in a very similar position at the moment, whether it's the junior miners, gold and silver, or in this particular case, energy fuels, which is in the uranium space. And the three main things to look at there, one is the, again, bullish pennant that's been building out since sort of, I suppose, March, April time. And then the black line above that is a long-term resistance line that goes back sort of years with energy fuels. And a break above that line would be very, very bullish and likely to lead to further sort of investment in the sector driven by people who are trading based on technical breakouts. That kind of move will catch people's attention and attract more money into the sector, given the fact that it's a pretty thinly traded sector. We could see a fairly rapid move up to the first target zone, up at around 5.5 to over $7 there. That target zone, when you zoom out on the chart, is based on horizontal support and resistance levels, historical horizontal support and resistance levels. So from where we are at the moment, around about $2.30, you're talking about a sort of 100% move. So as long as we stay within that bullish pennant, and I've been sort of quite happy if we stayed above that dotted line as well, because there's a dotted uptrend line leading us up towards the top of that pennant at the moment. But we may drop down to the lower support line somewhere around about $2. But that's only giving you sort of 30 cents of downside in a fairly strongly bullish pattern there where the upside is, well, from $2, the upside will be about 300% up to around about $6. So, it's all about trading probabilities. And this goes back to what I said at the start. The probability is that we stay within that bullish pennant because it's been tested 3 times already, and break out to the upside because, we're in a commodities bull market. So I think uranium's going to be part of that. And also, by the way, it's a seasonally strong time of year for uranium as well. And also uranium spot prices are being pressured upwards at the moment. There's been a lack of investment in the sector, with companies actually buying uranium in the spot market because the prices are that low that it actually costs more to get it out of the ground. So, that's a very strong fundamental reason for the price to go up as well. So if spot uranium prices go up, then the miners, of course, will benefit from that, and the overall sentiment improves. So, all the more reason to be looking at the percentages more strongly, to the upside rather than to the downside here.
Yeah, and again, Kevin, that's just taking all those puzzle pieces and really fitting them into that bullish sentiment for that sector. So let's move on to something we did kind of touch on earlier, is that general commodity bull market that seems to be emerging versus the general equities. And we'll look at copper here, and you have a lot of notes and some great information on this chart.
Yeah, I put this chart together quite a long time ago now, and I've been following the more recent symmetrical triangle that's been building out. But you can see 4, absolutely, to my mind anyway, absolutely beautiful chart patterns there. There's a bullish descending channel which broke to the upside, which then saw price sort of rise from, I don't know, about 70 cents all the way up to around about $1.40. So there's a sort of from the low point to the top there, sort of doubling in the price of copper, and then it sort of dropped into the arc formation, which is a pattern that repeats over and over. And the longer the arc takes to build out, the more sort of pent up energy is contained within the market as price breaks out, and price again dropped down to, well, in fact, I suppose around about 60 cents or at one point there in the early part of the century, around about 2001. And we saw that go all the way up towards somewhere around $4. So, at least sort of five times increase in price there. We then formed a sort of a bearish rising wedge, which copper price plummeted at that point. It sort of broke to the downside, and that was a very strong signal where, you get these trading patterns and price breaks to one side or the other. The probabilities then swing very strongly in favor of a significant drop in price, and it returned all the way back to the breakout level from the arc formation, took us back to roughly $1.30, $1.40, something like that. And since then, price has been sort of oscillating up and down, forming this symmetrical triangle. So that's given us a very clear support and resistance level, just as the previous 3 trading patterns gave us very clear support and resistance levels. And the last 3 trading patterns that built out, the sort of long-term trading patterns that built out, the descending channel, the arc, and the rising wedge, we've now got this symmetrical triangle. And exactly like the last 3 occasions, a close, a daily and weekly close, and particularly a monthly close above those resistance lines gives us the trend direction for a considerable period of time now. So you can see from the chart that we've moved and broken above the upper resistance line of the symmetrical triangle. You can see on my notes there that I've written on there that it's awaiting likely bullish resolution. That's because I obviously drew the chart quite some time ago, and I'd like to sort of keep these charts and bring them back again to sort of track them and sort of continue to be aware of where the charts work and where they don't work. It's no use really sort of pulling up a chart every time and reappraising it and looking at it afresh every time. You need to sort of learn from past sort of successes and failures, if you want to put it that way. But because this chart pattern's been building out since, I don't know, about 2009, that's a very long period of time. So that symmetrical triangle is without doubt a valid charting pattern, and we have without doubt broken above the upper resistance line now. So we've had the first daily close above that, and I tweeted on that a few days ago, and we're now sort of closing the week above that line. In fact, whilst I'm talking to you, I can probably just check and see where the copper price is, just get the live quote. But copper at the moment is, drum roll please, we're at 3%. We're up 3% today. So when I sent this chart across to you earlier on today, we were up 2%. And I posted on Twitter saying that we're looking as though we're heading towards a weekly close above that resistance line. Well, we're up just over 3% now, so copper is accelerating away to the upside. So that's another piece of the jigsaw puzzle, and it takes us right back to the start. And what we're saying at the very beginning of the interview is that we're looking at probabilities and we're looking at supporting evidence. And if ever there was a piece of supporting evidence for a commodities bull cycle, then it has to start with copper, resource for a whole range of industrial needs, whether it's electric vehicles, whether it's construction, whether it's tech industries. A whole range of industries rely on production and mining of copper. So if copper is signaling a bull market, then the commodities complex is looking healthy, and along with it, of course, precious metals. So yeah, it's a little bit of a sort of a canary in the coal mine. And also, just to mention in passing, the MACD indicator there has had a bull cross and it's back above zero. So I'd expect us to move up some more. I'd expect us to come back and test the breakout line. So it's quite likely that we'll move up to that sort of resistance zone somewhere around about $3.30, somewhere in that sort of zone, $3.40, $3.50, and then come back down and test the breakout. That'll get people bearish again, and that's exactly what you need. You need that kind of fluctuation, that kind of cyclical behavior. But the big picture for copper is bullish, and it shouldn't be disregarded. It's a really important barometer. Going back to my weather forecasting analogies, it's a very important barometer for the commodities sector in general.
Absolutely. Kevin, some great information and really illuminating chart patterns and information as usual. Thank you very much. Is there anything else you'd like to add before we wrap up here?
No, just good luck to everybody who's trading. Don't worry about the pullback in gold and silver. If you're invested long term, just stay the course, stay with the big picture. You can, of course, follow me on Twitter. Lots of big picture views there on gold and silver. Just keeps you focused when everybody else is getting bearish and selling at exactly the wrong time. So just my advice is just, be right, sit tight.
Absolutely. And probably the best place to find you is on Twitter. You have a little bit of a complicated handle, but we'll definitely include the link in all the show notes as well. If you'd like to share it with us, Kevin?
Yeah, sure. So I'm on Twitter. It's North Star is the name. And as you say, it's a complicated handle. It's at NORTHST 183633337.
Perfect, Kevin.
Way too complicated, but I'm afraid there must be a lot of other North Stars out there for them to give me all those numbers.
Yeah, absolutely. Like we say, the link to your complicated username is going to be provided in the show notes. We always appreciate having you on, Kevin. Thanks very much.
Okay, thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?